Hi, good morning, everyone. Good morning, Kenneth. Well, a great morning to start off with. First Saturday of 2024. Well, indeed, Malaysia stock has started the year.
Hi, good morning,
with,
everyone.
Exponential gain in some wearable stock.
A great morning
Could
to
it
start
be
off
a
with.
Chinese New Year
First
rally
Saturday
of
of
2024? Well, indeed, Malaysia stock has started the year.
Hi, good morning,
with,
everyone. Good morning,
Exponential
Kenneth.
gain in some wearable stock.
A great morning
Could
to
it
start
be
off
a
with.
Chinese New Year
First
rally
Saturday
of
of
2024? That's great to hear. Well, shout out for the recent up market and all the fans. There is investor in YTL Power, WC, that's great to hear. Well, shout out Sora Cable and Mindtech. Shout out for you guys. Congrats. And all the fans. There is investor in YTL Power, WC. That's great to hear. Well, shout out Sora Cable and Mindtech. Shout out for you guys. Congrats. And all the fans. There is investor in YTL Power, WC. That's great to hear. Well, shout out Sora Cable and Mindtech. Shout out for you guys. Congrats. And all the fans. There is
I see. Great.
Okay, well, let's start.
That's great.
Today, our market strategy will be the first half 24 market outlook. Title is Ascending into the Year of a Dragon. On the agenda-wise, we'll go through firstly the global markets review and outlook, followed by the Malaysia market review and outlook. Next, Malaysia's economy review and outlook, sector updates, first quarter market strategy, technical review and outlook, followed by the commodities market review and outlook. And lastly, there will be a Q&A session as well. On the global markets review, global markets have shifted into higher gear and subsequently ended the year on an upbeat tone. The said improvement was largely fueled by optimism surrounding the more dovish tone over the prospects of future interest rate cuts set by the US Federal Reserve, coupled with the expectation that the world's largest economy may be able to pull off a soft landing. Towards the end of the year, the US Federal Reserve has mentioned or signaled that there could be a potential 3 rate cuts moving into this year, and the first one likely to be as early as first quarter of 2024. Volatility briefly took control at the start of the final quarter of the year following the hotter than expected inflation data, coupled with the brief escalated geopolitical tension in the Middle East. However, Wall Street managed to advance with the Dow and S&P 500 finishing 12.4% Q-on-Q and 11.2% Q-on-Q respectively in the fourth quarter of 2023 to end the year on an upbeat tone with 13.7% year-on-year and 11.2% year-on-year higher respectively. Despite the recent gains on the US stock markets, valuations are still fairly attractive with the S&P 500 trading as prospective forward PE of 17.7 times for 2024, which is also slightly below the historical 5-year average of 22 times. Asia-Pacific regional markets closed fairly mixed as the sluggish Chinese economic data continues to weigh down the related markets. Japanese equities staged a mild pullback towards the end of the year but capped off 2023 with one of the best performance in 10 years. Over our neighbouring countries, the Jakarta Composite Index gained about 6.2% year-on-year as the basic material industry continues to attract foreign direct investment. You recall the Indonesian government has set out a policy that foreign investors will need to set up a manufacturing plant if they were to use the basic materials or resources in the country. They will need to set up a manufacturing plant using the local resources, produce the end product before selling off the end product or exporting the end product towards the other countries. So that has attracted a lot of foreign investments into the Indonesian market. On the flip side, the stock exchange of Thailand tumbled about 15.2%. This was mainly dragged down by the selling pressure from the foreign investors following the multi-months of uncertainty over the government regulatory changes. Looking at the selected global market indices review, Asia markets were fairly mixed with the Nikkei outperforming while the sluggish Chinese economic weighed down the Hang Seng and also the Shanghai Composite. All in all, in the fourth quarter, the MSCI World Index gained about 20%, whereas the Dow risen about 13.7%. Basically, European stock markets has outperformed, all closed in the positive territory. The Nikkei rose about 28.2%, but the Hang Seng and also the Shanghai Composite has fallen a little. On the FMKLCI wise, the FMKLCI continues its underperformance. Back in 2021, if you recall, the FMKLCI fell about 3.7%, followed by in 2022 about negative 4.6%, and last year it was a negative 2.7%. But on a brighter note, we are seeing the FMKLCI has risen about 2.1% in the fourth quarter, and the gains has also seen extending into the first week of the trading year in 2024 as well. So hopefully, the FMKLCI can manage to sustain its gains moving forward. To the global market outlook-wise, despite the recent outperformance in the global markets, forward earnings are expected to see further improvement with expectations of 10.5% year-on-year in global earnings growth for 2024. Consensus is pointing towards 3 potential rate cuts from the US Federal Reserve, with the first as early as the first quarter. Still, we think that any potential rate cuts will be very much data dependent onto several key aspects, such as the monthly inflation data, GDP growth, jobs data, and also the production data. In the meantime, we think that the forward earnings growth will likely to be propelled by the strength of the global economy growth that will be driven by revolution of technology such as AI, artificial intelligence, alongside with strong government spending in healthcare and financial sectors, as well as measures to incentivize energy transitions. Onto the US Federal Reserve interest rate expectation, this is a chart demonstrating or highlighting the consensus view over the potential interest rate cut. Moving forward, interest rate cut prognosis may likely to come in as early as the first quarter of this year, and the interest rate cut may likely to deepen moving into the second half of 2024. However, as we have mentioned, the pace of the interest rate cut or potential interest rate cut will be very much largely data dependent. The MSCI All World Index valuations are slightly appealing, with forward PE trading at 16.8 times and 15.2 times for 2024 and 2025 respectively, which is at the lower end against the long-term average of 18.7 to 20.1 times. Global corporate earnings growth estimates remain upbeat at 10.5% year-on-year for 2024. Asia Pacific equities are expected to remain choppy in view of the uncertainty surrounding the pace of China economic growth. Still, with the prospects of interest rate cut in the US, we think that foreign funds may likely to tilt their heads to the emerging markets, including Malaysia as well, owing to several factors. Firstly is the recovery of the emerging market currencies. Attractive valuations with regional markets are lagging behind the strong strides undertaken by Wall Street in 2023, and also the more stability in geopolitical scene across several neighboring countries, including the Malaysia as well, following the conclusion of the six state elections in August. Risk of recessions for the next 12 months is cooling off to 50%. Base case scenarios, should a recession looms, improving jobs data and healthy consumer spending should provide a cushion for soft landing. We think that the risk of recession is coming off is mainly due to multiple factors, such as the tapering of inflationary pressure, prospects of interest rate cuts to shore up economic growth, declining US Treasury yields, although it's currently still inverted at this moment and is hovering at around the 4% level. And lastly will be the rapid evolvement of technology advancements. This is a chart of the US recession probability. Early on, you can see there's a spike here, mainly due to the COVID-19 occurrence pandemic, and since then it has subsequently dived down. But recently has recovered. It has recently gone up again. The risk of recession has recently gone up again due to the slowdown of the economic data. But on a brighter note, in recent months, we are seeing the risk of recession has also came off. Back home wise, on the Malaysian markets, Malaysia equities have turned fairly upbeat, with investors nibble onto beaten down stocks, particularly in the second half of this last year. Much of the improvement was attributed to the uncertainty in the political scenes, following the status quo outcome from the sixth state election held on the 12th of August last year. Foreign funds, however, remain on the net selling position with an outflow of 2.29 billion throughout 2023. Consequently, the FMKRCI fell about 2.73% year-on-year in last year. With the political uncertainty taking a backseat, coupled with the tabling of a budget 2024, which signals a steadfast commitment towards fiscal consolidation, signs of foreign funds returning to the local scene were noticeable in recent months. Not just that, in the first week of the trading week this year, we are also seeing foreign funds came into the Bursa Malaysia with a net buying position of about approximately 400 million. So that has shot up the FMKRCI performance in the first week of this year, with the key index managed to break through above the 1465 stiff resistance. Looking at this graph, these are foreign fund participants' movements on a monthly basis against the FMKRCI performance. The blue color lines is the FMKRCI performance. Is actually very much positively correlated with the foreign funds. When the FMKRCI underperforms, this was mainly dragged down by the foreign fund outflow. But when we are seeing foreign funds as buying into Malaysia equities, you can see that the FMKRCI index has managed to stabilize. So if we are seeing foreign funds continues to buy into Malaysia equities, we could anticipate the FMKRCI to chart higher moving into 2024. We think that challenges will likely to take place moving forward in the Malaysian market, with consumer spending likely to take a hit on the subsidy rationalization. However, further clarity on the subsidy rationalization, such as the timing of implementation and also further details, will be the key focus on moving forward. The introduction of EPF account tree will likely to provide some elevation to the consumer spending, but likewise with the subsidy rationalization, the further clarity on the implementation and also the timing of the implementation will likely to be the key focus of the EPF account tree. That may likely to the labour force wise remains relatively healthy, with unemployment rate held steady at 3.4% as of end of 2023. However, despite the low base of the unemployment rate, challenges remain on the fall, with upskilling of human capital in bid to improve competitiveness and consequently improve wages growth. If I recall back in 15 years ago when I started my career, my wages is at roughly around the 2005 per month, and after 15 to 20 years later, the basic salary of a fresh grad is still at around that levels, or at most the fresh grad is only getting at close to 3,000 per month. So even if after about more than a decade long, wages has been a very much a stagnant thing, and prices of goods and services continues to increase on a yearly basis. Onto the Malaysian market-wise, average daily traded volume stood at 3.26 billion shares on Bursa Malaysia. This was an up of compared to 2.82 billion shares recorded in 2022. This was owing to the stability in the market, particularly towards the second half of 2023, whereby investors nibble onto beaten down shares. On the other hand, average transacted value was relatively subdued. It was unchanged at 2.05 billion from average of 2.06 billion recorded in the largest caps stock turns less attractive, which was evident with the foreign fund outflow of 2.29 billion set in 2023. On the retail participants wise, total transacted value for last year stood at 272.46 billion. This was slightly up compared to 226.47 billion recorded in 2022. This was the Bursa Malaysia's 2023 sector performances. Leading the gains or leading the pack was the Bursa Malaysia Utilities Index, rising close to about slightly more than 50% in last year, followed by the property sector and also the construction sector, and the fourth will be the healthcare sector. On the consumer index wise, we are seeing the underperformance of negative 5.6%. Bulk of the gains on the utilities index was mainly driven by the sharp gains on YTL Corporation and also YTL Power International Berhad, and this outperformance of these two shares have also led them to include into the FMKLCI constituent list towards the end of the year as well. The property index was mainly spurred by the revival of the Iskandar Malaysia 2.0 and also with the ongoing Johor Bahru Singapore RTS project, and also potential revival of the Malaysia's Singapore High Speed Rail project that has elevated the property scene, the property across Johor Bahru. And likewise, that has transpired to improvement in the construction projects as well. Onto the budget 2024, there was no cut in any mega infrastructure projects, although there were no new mega infrastructure projects being introduced. Still, we think that the key infrastructure projects would likely to go on or likely to accelerate moving into 2024, given that the stability of the political scenes. The carbon market conditions represent trading opportunities as the key index remains largely in tune with the overseas developments. Moving forward, investors will be embracing more volatility ahead of the US presidential election, but that may likely to take place moving into the second half of the year. So the first half will likely to be a more calm market condition, but volatility may likely to reignite into second half. With the prospects of interest rate cut from the US Federal Reserve, the move is expected to be favorable for the Ringgit Malaysia, and the US Malaysia interest rate gap narrows. We reckon that Bank Negara may likely to stay pat onto the interest rate at least in the first half of 2024. Although the general market sentiment remain upbeat, we think that recovery remain choppy as quick profit taking activities may sneak into the picture. Still, the improving corporate results in general may present further gains moving forward. Given the calmer market conditions, we reckon that the prospects of earnings growth remains on the cards. In 2024, the earnings per share or EPS is projected to grow at 11.6% year-on-year. This may present some investment or trading opportunities. For now, Malaysia stocks remains slightly undervalued, with FMKLCI trading at PERs of 13.1 times and 12.2 times for 2024 and 2025 respectively. The price to earnings ratio are slightly below the historical 5-year forward average of 17.2 times, implying potential upside in our view. Our in-house target for 2024 and 2025 year-end for FMKLCI are at 1560 and also 1650 respectively, based on assigned 14 times PE multiple. The 14 times PE multiple is also in line with the historical average. This is a chart on the 5-year historical FMKLCI PE band. The blue color line is the FMKLCI movement. If you look at the past before the COVID-19 strikes, the FMKLCI is trading largely around the historical average, which is the dotted line, the yellow color dotted line. But since then, we are seeing, since the middle of 2021, we are seeing there's a discount or there's a gap between the historical average compared to the actual FMKLCI movement. So currently, given that there's still a discount, we think that valuations are still very much attractive, and that may present for further upside onto the FMKLCI moving forward. Moving on to the Malaysia Economic Review, 2023 experienced a lackluster growth with 9 months 2023 GDP growth at 3.9% year-on-year. This compared to 9.2% in the 9 months. There was a slowdown compared to 9.2%, mainly due to the weakening of external trade demand, which reflected in both the exports and also the imports. Economic growth in 2023 was primarily supported by the services sector, with enhancement in both consumer and business-related services, and also the construction sector, benefiting from the extensive infrastructure projects and smaller scale initiatives. Headline inflation for 2023 year-to-date moderated to 2.6%, primarily attributed to easing input costs, commodities, and also the high base effect. However, inflation rate remains at a higher end against the long-term average of 2%. The forecast for full year 2023 headline inflation maintained at 2.6% year-on-year, reflecting a potential moderation of 3.4% year-on-year from in 2022. Malaysia's external trade decelerated in line with the worldwide economic slowdown. This performance is consistent with the negative growth recorded in the imports data of Malaysia's major trading partners such as Korea, China, and Indonesia. On the currency-wise, Malaysia ringgit has depreciated roughly around 4.1% year-on-year to 2023 against the US dollar. The depreciation is mainly attributed to the hawkish stance by the US Federal Reserve in the first half of last year, and also the weaker than expected recovery of China's economic growth, which is a significant trade partner to Malaysia. On to the Malaysia GDP-wise, moving into 2024, the government expressed confidence in achieving 5% year-on-year GDP target through the Madani economic reformation. However, our internal forecast for the real GDP for 2024 suggests a relatively moderate growth of 4.1% year-on-year, as the outlook may be tempered by this expected slowdown in the domestic demand, attributed to several tax hikes and introductions. Several measures, including the hike of SST to 8%, higher excise duty of tobacco and sugar-contained beverages, subsidies rationalization, and lifting of a price ceiling of certain items, are expected to set the stage for high inflation and elevate cost of living in 2024. Our in-house CPI forecast stands at 3.2% year-on-year compared to the government's forecast of 2.5 to 3%. Moving forward on the ringgit-wise, we expect anticipation of a stronger current accounts surplus driven by the gradual recovery in exports and increased inbound tourists may likely to see improvement in the ringgit for the year against the US dollar. On the OPR-wise, Bank Negara is likely to maintain the OPR at 3% as the terminal rate before the potential rate cut to occur in fourth quarter. However, this may likely to remain largely data dependent. If the economy remains relatively solid, then there's no reason for Bank Negara to cut or uplift the interest rate. So, if the Bank Negara were to if the GDP growth were to stay pat at close to about 5%, I think Bank Negara may likely to keep the interest rate at current levels. But however, if we are seeing a sharper than expected economic downturn, then Bank Negara may likely to be forced to cut rates earlier than expected.
That's good news for property.
Right. Yeah. That will be. I think that will be not just the property, but I think consumer spending will also improve as well.
Yeah, true.
With higher disposable income. Looking at the Malaysia's economic data, inflation has been tapering off, which is a good sign. However, the industrial production index remains fairly slightly on a downbeat tone. It has been lingering slightly on the negative level of choppiness take place. On the wholesale retail trade value has also tapered off. The producer price index has also came off, so that has led to the lower inflation. At the same time, the unemployment rate has also tapered off, which is a good sign for the economy. However, like what we have mentioned earlier on, the challenges remains on the floor over the upskilling to improve the wages. The sector updates, there are selected sectors under our topics for this first half 2024. Firstly will be the construction sector. We are always on this sector as in the third quarter of 2023, the construction sector remained upbeat with growth of 9.6% year-on-year, with construction value completed totaling about 33.4 billion. The construction index registered to 25.8% year-on-year gains, is the second best outperformer on the Bursa Malaysia, closing at 191.93 points in 2023, as the recovery takes place amid the improving foreign labor outlook. These charts demonstrate the value of contracts completed against the construction index. The blue color line is the construction index. As you can see, that the construction index has been beaten down early on following the weaker construction contracts are completed. There was a shortage of labor from there following the multiple MCOs taking place. But since then, we are seeing a stability in the construction index, and the value of the construction contracts has been picking up. And recently, it has been on a quarters high. The construction contracts completed, and since then, the construction index has also risen to about multi-quarters high at 184.62, and the construction index on the Bursa Malaysia has closed at 191.93. So we are anticipating the construction complex to see contracts completed to see a further improvement, potentially towards the close towards the 180 level. The construction sector shifted into the higher gear moving into 2024 as the political uncertainties to a backseat following the favourable outcome from the state's election. Among the mega infrastructure projects to keep an eye on would be like East Coast Highway 3, the flood mitigation projects which the government recently has been emphasizing onto, the West Coast Expressway, East Coast Railing, Central Spine Road, MRT 3, which is expected to take off in this quarter, Via Lepas Rapid Transit in Penang, Pan Borneo Highway Sabah, mainly in Sabah section, and also the Johor Bahru Singapore Rapid Transit system. The acceleration of mega infrastructure projects in the pipeline, as well as the upward revision of allocation of higher development expenditure under the 12th Malaysia midterm plan review, will spur the Malaysia economic growth. Construction activities under the private sector are expected to remain vibrant, premised to the revolution of technological advancement, which resulted in mushrooming of data centers, warehousing facilities, as well as construction of new semiconductor plants. Our topic under the construction sector will be AME Elite Construction Consortium Berhad, with a fair value of RM1.80. We like this company for its established presence in the industrial building development that will be leveraging onto the construction of new manufacturing facilities, as well as the rising foreign direct investment into the country. Meanwhile, the group is also touted as one of the indirect beneficiaries from the China Plus One strategy. China Plus One is whereby investors were to mitigate their risk or diversify their risk. Apart from setting up their plants in China, they will set up plants in neighboring countries in Southeast Asia. So, because China is closing down their economy, so and the prospects of the Chinese economy slow down, investors may likely to shift their manufacturing activities not just to Malaysia but to countries like Vietnam, Indonesia, Myanmar, Thailand as well.
I see. What is the target that you're actually looking at for this AME?
Our target is at RM1.80, and for AME wise, they have done quite well on their industrial park in Johor, and moving forward they are going to replicate their success in Johor into Penang.
I see. Okay.
Current share price is at around the RM1.60 level, so I think that still presents some upside in our view. For now, the construction sector is trading at forward PEs of 13 times and about close to 12 times for 2024 and 2025 respectively, which is below their historical 2-year average of 15 times. This implies potential upside for the foreseeable future. We view that the construction sector will play an integral role for Malaysia to transform into a high-income nation as early as 2026. But however, some key risks remain, such as the increasing labour costs, which may likely to squeeze margins for contractors, elevated building material costs, delayed or slowdown in project execution. Overall, we are overweight onto this sector, premised to the reiteration of big-ticket items under Budget 2024. These are some of our top picks. AME Elite Consortium Berhad, with a target price of 195. potential upside of close to 15 or towards the 20% level. We like also Kerjaya Prospect Group Berhad. Gamuda Berhad would be one of the biggest beneficiaries for the rollout of mega infrastructure projects. Some construction supported by their in-house and also exposure towards the rail-related projects as well. To the property sector, the property sector recorded a decent quarter with a total property transactions value climbing to 22.6% year-on-year to 57.15 billion in the third quarter. New residential launches rose to almost 6,900 units in the third quarter against 4,800 units in the second quarter, while the sales of new launches increased 37.6%, highlighting the stability of housing demand. Average property prices of transaction also rose to about 500,000 unit, which was the highest since the third quarter of 2021. Also supporting the property sector was the stability of the loan approval rate, averaging about 44% in the 11 months. This may ensure sustainability of the property sector. If we look into the historical quarterly property transactions, we are seeing improvement trend. Then there was a slowdown mainly impacted by the multiple MCOs, but since then it has been stable and has climbed higher. Recently it has also climbed above the 50 billion mark for the first time since before COVID. So this signals that there's demand for property and including this above the 500,000 house price above the 500,000 mark. This loan monthly statistic wise, it has been a fairly stable. So long as it's above the 40% level, I think that this may continue to ensure sustainability moving forward on the property sector. On the property sector wise, we think that the outlook remains fairly stable, driven by the healthy loan applications, which signals the demand remains fairly solid. I think overall, in general, all Malaysians will want to want to have their own property. But however, one of the key reasons why there was a gap is because of the price and also the wages or the income disparity. Some of the key catalysts for the property sector will be the Johor, Klang Valley and Penang theme. For Johor, there will be the construction of RTS link that is slated to be completed in 2026. So that may likely to boost the Johor property market, and also the special economic zone for the Johor property announced by our Prime Minister as of late. Onto the Klang Valley, there will be the potential revival of the high-speed rail as well as the rapid urbanization. So we are seeing a lot of citizens of Malaysia migrating into Klang Valley due to the better job opportunities. At the same time, the improvement in the rail and road infrastructure are likely to see improvement. Onto the Penang, the development of a Penang Transport Master Plan will be one of the key catalysts for the Penang market. Malaysia household debt to GDP ratio remains stable at about 82%, supported by the stable employment growth. I think that moving forward, the ratio will likely to remain at around the 80% level. Given that further OPR hikes remains off the table, prospective purchasers will likely to be able to make long-term plans and quick decisions in regards to loan applications. You recall that in 2023, particularly the first half of the year, we are seeing the upward move on the OPR hikes. So that has dampened the loan applications on Malaysians in general. But with the stability of the OPR, I think that loan approval and processes will likely to speed up. For now, the forward PB for the property sector is trading at 0.5 times for 2024, which is fair against the historical average between 0.4 and also 0.6 times. Our top picks are Legenda. We have a buy call with a fair value of 163 for its strong exposure in the affordable housing segment, which is strongly aligned with the mass market demand. And also Skyworld, we have a buy with a fair value of 94 cents for its strong historical take-up rates backed by competitive property pricing and strategic locations. Some of the key risks include difficulty to pass on higher building material costs to prospective purchasers, given the prices of property and also the income disparity, higher compliance costs, and also the rising utilities costs. We are neutral on the property sector on the back of the stability in demand for residential properties, particularly for units priced below the 500,000. Improved demand for industrial properties as a proxy to rising foreign direct investment following the US-China trade diversion, as well as supportive measures from the government to aid first-time home buyers announced under most of the recent budgets. Onto the property sector top picks wise, we have Legenda and SkyWorld. We also like OSK and Matrix for its established names, household names, and also strong track record in the development of their township. Meanwhile, Sunway Berhad is one of the established property players. They have also exposure in the Johor. They still have pockets of land in Johor as well. Moving on to the technology sector, we are neutral on this as the Bursa Malaysia technology sector displayed an remarkable performance in 2023, reflecting the broader challenges faced by the global semiconductor sector after a period of remarkable growth from 2019 to 2022. The SIA indicated a 14.3% year-on-year decline in the global semiconductor sales in 2023. This was mainly due to the inventory adjustment for most of the semiconductor players. Local companies in the outsourced semiconductor assembly and test, OSAT and electronics manufacturing services (EMS) face challenges delivering disappointing FY23 results in terms of both revenue and also the margins. However, companies involved in the ATE space and those serving the domestic markets showed resilience. This is a chart of the worldwide semiconductor sales. You can see that until the second half of the year, we are seeing an improvement in the pickup in the worldwide semiconductor sales. Although it's still very much below the previous levels, we are seeing signs of or green shoots of a recovery move onto the semiconductor space. In anticipation of an uptick in the stock replenishment cycle and also the low base effect, earnings of the technology sector are expected to gradually recover in this year. Recovery in the technology is anticipated to occur gradually, particularly in the second half of this year, after a relatively subdued start towards the year, which is expected considering the seasonality. Wise, in the first half, traditionally, semiconductor players are likely to be on a slower pace. If you looking at an example like iPhone traditionally roll out the newer models in the months of like October or September. This normally in the second half of the year. So so traditionally in the first half it will be a slightly slower growth, but in the second half wise we will anticipate a further growth moving forward. Onto the Bursa Malaysia Technology Index is currently trading at 32.5 times in 2023 PE and 25 times for 2024 PE, with earnings per share anticipated to decrease 25.9% in last year before staging a rebound of 29.2% in this year. We opine that the sector's current valuation at 25 times for 2024 is less attractive as the timing of the strong recovery remains ambiguous. Our top pick are Aurelius Technology, ATech. We have a buy call with a fair value of 3.22 due to their exposure in the IoT, which sees relatively lower impact from the cooling demand, particularly from the semiconductor space. Strong profit growth and prospects with massive expansion coupled with the margin enhancement. Meanwhile, we also like Infoline Tech Group Berhad. We have a buy with a fair value of 1.15 for a strong growth prospects driven by the large-scale expansion on the cards, coupled with the favorable industry outlook on the IT infrastructure and cybersecurity.
I see. Kenneth, how do you see SMRT in this sense? Would that be one of your pick?
Yes, we also like SMRT right now, but given the recent strong gains in their share prices, we think that upsides has been minimized, so that if share prices were to cool off, or should the company manage to deliver better than expected fundamentals, we think that there could be potential upside over the longer term basis.
I see. Okay.
Some of the key risks for the technology sector would be softer seasonal demand and slower than expected inventory adjustment, a long high interest rate, which may keep valuations on the lower end against the historical average. All in all, we are neutral on the technology sector and advocate to monitor over the ongoing global economic conditions for any potential signals that may lead towards the potential substantial recovery. But I think for now, recovery may likely to be gradual in the first half of the year before taking off strongly in the second half. So these are some of the calls on. We have Infotech, QAS, Chrono, Aurelius, ATEC, and also Frontcan. All of them have buy calls under our coverage, except for Frontcan, given that their potential upside is only at 2.5%. However, we think that fundamentals of these companies may likely to improve moving into this year. On to the healthcare sector wise, we are neutral on this sector. Sentiment over the healthcare sector have turned more favorable, particularly within the gloves sector, which continues to narrow their losses as well as chalking in marginal profits under the financial period under review in the third quarter. Healthcare services and equipment players will be reinforced by the higher budget allocation under Budget 2024, which saw about 13.5% year-on-year rise in the allocation to 41.2 billion. Healthcare-related projects such as development and upgrade of hospital facilities as well as equipment aligns with the Malaysia government goal to gradually uplift public health expenditure to 5% of GDP, which bodes well for the sector. Currently, the healthcare sector is only making up to about 2.5 to 3% of the GDP. On to this chart-wise, this is the natural rubber concentrated latex price. We are seeing a softening in the prices and currently turning stable. Should this price turns stable in moving into subsequent months or quarters, we think that this could be favorable for the gloves-related players. Looking at the budget 2024 wise, the total allocation is at close to 400 billion, and the healthcare sector makes up to one of the largest chunk at about 41.2%. The healthcare sector is the second largest, has the second largest budget allocation coming off. From the first place was the education sector, followed by the healthcare. So I think moving forward, moving to subsequent budgets, I think that the numbers will continue to rise as the government continues to emphasize onto the healthcare expenditures. The average selling price for rubber gloves remain fairly stable at approximately 20 to 22 US dollar per 1,000 pieces in the first half, as the pricing gap with peers from regional players are narrow. Medical tourists are also returning to Malaysia towards the pre-pandemic levels, supported by reopening of our borders, with visa-free travel for Chinese nationals, improved quality healthcare and competitive pricing are setting a stage for improvement in the healthcare industry. Meanwhile, back home-wise, the aging population, rising healthcare awareness, particularly post-COVID-19, improving healthcare technology will be some of the key avenue drivers for the healthcare industry moving forward as well. The recent recovery in the share prices from glove stocks has reflected the prospects of the improved fundamentals. We don't have any top picks under the gloves sector, but we favor Harta Legaf for its substantial net cash position of 1.64 billion and also strong operational efficiency, which may be able to weather further economic shocks. Key risks include stiff competition, fluctuation in raw material costs, and change in healthcare regulatory may impact the industry operations landscape. We upgrade our call on this sector from underweight to neutral, as the recent recovery in the share price, particularly gloves players, have reflected their improving fundamentals. Still, we do not discount on potential re-rating potentially towards the overweight in the future, should the pace of recovery shoot above our expectations. These are some of the stocks top picks for this first half of 2024 under the healthcare sector. We have two glove sector like Heartgard and also Top Gloves. Both of them are the key players in the gloves industry. Both of them are also the part of the SI constituents back when the gloves are ready. We also like SuperComnet for its exposure in the medical products and services segment. IHH Healthcare, one of the biggest player in the healthcare hospital services industry space, and also the Optimax Holdings Berhad, one of the prominent players in the eye specialist healthcare.
Okay. All right. Now we are going for. Stay tuned, guys. We'll be back shortly for the investment strategy. Kenneth will be telling you what to buy later on for this Chinese New Year rally. Definitely is actually for the whole first quarter, but however, since Chinese New Year is coming around the corner, so well, for a start of the year, we see some stock actually rally from this week. So probably there will be more coming up. So, well, stay tuned. We will come back later on.
Buy old Telegram, hello new Telegram. Bid farewell to the previous Telegram channel and welcome the dawn of a fresh era with Apex on our brand new Telegram page. This migration is a strategic move, consolidating our resources to enhance the delivery of crucial information on equity and derivatives, ensuring an even more streamlined experience for our valued clients. The old Telegram will gracefully retire soon, ceasing all updates on trading recommendations and research papers. To stay in the loop and continue receiving exclusive insights, swiftly transition with us to the new Telegram group. Embrace the future of seamless communication and unparalleled market intelligence. Join us now. Greetings, Apex enthusiasts! Brace yourselves for a groundbreaking moment as Apex unveils a revolutionary array of products designed to elevate your trading experience. Prepare to witness the pinnacle of derivatives foreign trading as we introduce a cutting-edge platform with zero market data fees exclusively for our esteemed clients who seize this opportunity today. Experience the sizzle of our latest offering, discretionary trading in both equity and derivatives products. Allow our seasoned professional traders to take the reins, guiding your investments towards unprecedented success. And there's more. Introducing the Apex Academy, a bespoke educational platform meticulously crafted for our valued investors and clients. Embark on a comprehensive journey through the intricacies of trading and investment, arming yourself with invaluable knowledge to navigate the financial markets with confidence. This is not just a platform, it's a gateway to a heightened trading experience. Join us in shaping the future of your investments. Buy old Telegram, hello new Telegram. Bid farewell to the previous Telegram channel and welcome the dawn of a fresh era with Apex on our brand new Telegram page. This migration is a strategic move, consolidating our resources to enhance the delivery of crucial information on equity and derivatives, ensuring an even more streamlined experience for our valued clients. The old Telegram will gracefully retire soon, ceasing all updates on trading recommendations and research papers. To stay in the loop and continue receiving exclusive insights, swiftly transition with us to the new Telegram group. Embrace the future of seamless communication and unparalleled market intelligence. Join us now.
Hi, welcome back. Well, Kenneth, there's some question from some of the viewers. They were asking because just now you were talking about soft landing. So, if it's a soft landing, would it be a bear or would it be a uptrend, a bull?
I think if a soft landing, I think bull market is still there. Soft landing will likely to see a soft or small market correction, but in general, the bull will likely to take the bulls will likely to take control towards the later end.
Okay,
So-
so you're expecting about Q4 or Q3 to pick up.
Yeah, hopefully.
We hope that too. But what if soft landing doesn't happen and hard landing kicks in?
If the hard landing kicks in, I think the government or the central bankers across the globe can tweak their fiscal policy. For instance, instead of the potential 3 interest rate cut from the US Federal Reserve, they may take more than 3, perhaps 5 to 6 interest rate cuts in order to spur the economy.
Okay. Increasing the interest rate.
Cutting the
Cutting
interest rate.
I see. So, if it's cutting the interest rate to spur the property market and also the borrowing.
Yes, because when central bankers cuts the interest rate, basically that encourage people to spend.
Yes.
Yes, so instead of saving into the bank, people will spend in order to drive the economy.
Okay.
He can be spending on like retail items, consumer products. He can be spending on big ticket items like property, vehicles as well.
I see, I see. So it looks like hard landing is a lesser chance.
For now, based on the current economic scenario, the chances of hard landing is pretty low or pretty thin at this point of time.
Okay.
Given that the number of jobs are still relatively solid, unemployment rate is still at a lower end. In the meantime, we are still seeing economic growth or projection. They are still seeing positive numbers in terms of GDP.
Okay, great. So, well, during the MCO, a lot of people lost their job, and well, of course, probably market is recovering at the moment. Inflation also kicks in, so making the M40, dropping to B40, and of course, some M40 went to T20 as well. So making the wealth parity gap become bigger and bigger. Is that? I don't think that one is a healthy situation. But what do you see? How it actually affect the economy in Malaysia, though?
Yeah, actually, this trend has been ongoing for the past many years, and I think under the budget 2024, the government has outlined that they will be undertaking the subsidy rationalization. So I think that may likely to that may likely to bridge a gap between the T20 and also the B40 levels.
Okay.
So only the truly well-deserved would like to enjoy the subsidy, whereas the T20, which consumes more, would likely to pay more taxes or pay more for the goods and services.
Oh, okay, good. Have you been to the TRX lately?
No, I have not been to the TRX lately, but I heard that it's well packed at this point of time.
Well, exactly. So we were talking about recession, but when you go to the TRX, there's flooded with people. So we're thinking, is there any chance of Malaysia being, Southeast Asia financial hub? Is there a chance for Malaysia? TRX is actually built for that purpose. Well, it's our vision. I don't know whether is there any opportunity that Malaysia can take in for the economy, replacing, no, I wouldn't say replacing Hong Kong or replacing Singapore, but would there be any chance of Malaysia being the financial hub in Southeast Asia, though?
I think we don't discount that possibility, but replacing or replicating what Hong Kong or Singapore markets are doing, I think that will take a long period of time for the Malaysia. This is because of the difference in the regulations between like the Malaysia and also Singapore and Hong Kong. Singapore and Hong Kong regulations are more looser, so that has attracted more foreign investors.
See.
Because like for example, like in the Malaysia economy, there are certain things that are very much well regulated by the government. So it's slightly more difficult for foreigners to penetrate into the Malaysia market.
I see. So that will depends on our own SME or our own financial institute to work out for Malaysia. I see. So, well, we'll always support the government. Well, government, please help Malaysia as well. We do hope to see Malaysia a better place to stay. Well, let's come back. Let's come back, and Kenneth will actually bring you to some of the stock that he thinks might perform well in the first quarter, and probably if let's say we are lucky, we can get something for our Chinese New Year ang pao.
Okay, we move on to the first half 24 market strategy, which I think most of the viewers are curious about or staying on to. On our first half 24 strategy wise, we are turning slightly more aggressive with selected sectors to be in focus, with selective sectors that is bracing for further earnings growth. Malaysia economic fundamentals remains fairly stable and attractive, and the attractive valuations could entice foreign funds inflow as evident in the first week of the trading weak in this year, we are already seeing foreign funds are coming back into the Malaysian market due to their attractive valuations proposition. However, the execution of the key blueprints laid out in 2023 will be the key focal point to drive the economic reformation, such as the NETR, the NP 2030, and also the 12 Malaysia Plan midterm review. The prospects of earnings growth are still on the cards, coupled with the return of investment flow in search for higher yields in anticipation of interest rate cuts, sets a perfect stage for the equities markets to move higher moving forward into 2024. We have 4 major sectors under our top picks, such as the construction sector, which will be anticipating news flow to accelerate from tenders and awards of key mega infrastructure projects. However, prospects of earnings growth remains dim as the execution and billings may only hasten towards the end of this year or early 2025. Most likely, the awards were likely to come in from the start of the year, but the execution-wise and the billings-wise we will only see the numbers flowing in, moving into the fundamentals, or the numbers flowing in, moving into end of 2024 or early 2025. But however, I think for Malaysia markets-wise, it's very much news-driven. Whenever there's new contracts being introduced or being awarded, the share prices of the companies will likely to move accordingly. For the property sector-wise, it's expected to be uplifted by the key mega infrastructure transport projects, with them skewed towards the property projects in surrounding vicinities. Also, expectation of interest rate upcycle, which may have peaked, will allow planned purchase to progress accordingly. For example, a person A has a disposal income of a certain amount, and he or she may only allow to borrow certain amount from the financial institution to finance their mortgage. So if interest rate continues to inch higher, their affordability to take up the new loans will have diminished. But if the interest rate remains stable or comes down, then their purchasing power for big ticket items will improve. For the technology sector-wise, it's currently building onto the recovery of the semiconductor sales post-inventory adjustment from the semiconductor players, with plant expansions remains intact and mushrooming of data centers following the revolution of digital space, rising adoption of AI, and also the Internet of Things. So the revolution of the technology has given further a new upcycle for the technology sector moving into 2024. For the healthcare sector-wise, particularly gloves players may build on to their recovery trend. That the prospects of improving fundamentals are largely in the cards at this point of time, while the healthcare services providers, equipment manufacturers will continue to ride onto the industry expansion following the higher budget allocation tabled under budget 2024 for the healthcare industry. Other sector that we like will be the renewable energy sector, on the back of the various incentives to spur business to adopt more green and sustainable business, not just solar and also EV, but all business across all industries are encouraged to adopt more green practices. For example, like if you're working in an office, you probably can print out less papers. Things can be stored into a drives or into cloud. For the tourism sector-wise, is riding onto the full-blown recovery in global travel, alongside with the visa-free entry into Malaysia and China for Malaysia and China citizens that takes effect in last month, as well as the healthcare sector in anticipation of the improving outlook for gloves sectors. Meanwhile, the higher budget allocation also sets a stage for the healthcare industry. So these are our strategy for the first half. There was a typo error here. It should be a first half of 24 strategy. We like the technology sector, healthcare, construction, and property, and this can be combined with the slightly more defensive stocks like under the tourism and also renewable energy. So these are some of the top picks in the first half of 2024. We like AME and Gamuda under the construction sector, Legenda and also OSK for property, Supercomnet and Optimax for healthcare, Infotech and ATech for under the technology sector. So all of them have double-digit potential upside based on their prospective target price. You can have actually this table has already been published out in our first half 24 market outlook on the 2nd of January. You can log into our website and you can go for the research reports and search for this strategy report. Under our top picks for this year, we like AME, which is supported by unbilled sales of more than 200 million, an outstanding construction engineering order book of 250 million. This will likely to sustain their earnings visibility over the next 1.5 to 2 years. The company is also has a new industrial park measuring 176 acres located at Penang that carries an estimated GDV of 1.5 billion. This will be a new avenue of growth for the company. They have done really well in Johor at Senai, and they will likely to replicate their success into the Penang industrial park. At the same time, the rising FDI will likely to fuel the industrial property demand as well, with manufacturers players shifting their operations out from China towards other countries in the Asian region. We also like Gamuda with a target price of 5 ringgit and 53 cents. They are backed by a solid outstanding order book of 27.8 billion for various contracts. They are the front runner for mega infrastructure transport projects, given their strong historical ability to execute previous projects. Established presence within Australia, Singapore, and Taiwan markets through multiple job wins in the recent years as well. So they are not just relying into Malaysia markets, but across other countries. For the property sector-wise, we like Legenda with a target price of 1 ringgit and 43 cents. They are supported by unbilled sales of 855 million, which will provide a strong earning visibility over the next 12 months. Their balanced land bank of 4,700 acres that carries estimated GDP of 12.5 billion will provide long-term revenue visibility. They are mainly developing township projects. So these township projects are priced like single-story house, landed house are priced below 200,000. So that with this affordability projects, that has attracted the mass market. We also like OSK with a target price of 177 cents. They are anchored by unbilled sales of 1.2 billion. Balanced land bank of close to 2,000 acres that carries an estimated GDP of 15.5 billion will provide long-term revenue visibility. They also have Surau Township in Sungai Petani and also Negeri Sembilan. They also have a strategic 10.2% equity stake in RHB Bank Berhad, which will provide regular income stream for regular and decent dividends. We recall that they have sold RHB Investment Bank to they have sold OSK Investment Bank to RHB. So what they get is a certain equity stake in RHB for the sale of their operations. So with this 10% stake, they can get regular dividend payments, and they are quite a good dividend paymaster on OSK. For Scomnet wise, their medical segment will be boosted by key clients, namely Edward Life Sciences and the recovery in orders from Ambu. These Edward Life Sciences and so Ambu are major multinational healthcare service providers globally. The completion of revamp of Stellantis Gurun plant in first half will likely to boost the automotive segment, because they are supplying fuel tank and also wire harness to Stellantis, which manufactures Peugeot models, Peugeot car vehicle models. Continuous rollout of medical products will likely to drive the growth prospects moving forward. For Optimax wise, the growth will likely to emanate from the opening of a new ambulatory care centers (ACC) in Cambodia, Atria and Kota Kinabalu in FY24. The group is also in collaboration with Cellgate for the Setia Alam Hospital Eye Specialist Center, which is later to commence in the fourth quarter of 2024. They have also targeted or earmarked Cambodia and Vietnam for geographical expansion to capture the growing demand for LASIK procedures. To the technology sector wise, we have Infotech with a target price of $1.15. The company will be bolstered by steady earnings stream through managed IT services segment in bid to generate recurring income stream, ability to secure new customers bolstered by their largest retail client Dell Technologies through their substantial planned capex. Dell is actually currently expanding aggressively at this moment. They are also benefiting from the government's initiatives to promote the IT infrastructure and cybersecurity industries, with development of digital infrastructure is being encouraged through technology-friendly policies. For ATech-wise, we have a target price of $3.32. Optimism in the EMS sector recovery is fueled by expectations of global economic recovery, coupled with the tail end of the global interest rate hike cycle. This stocking of activities from customers are bottoming out, with order book has seen increasing from 322 million in the month of September. It has risen to 473 million in the month of December. With the improvement in the order book, we expect billings to shift into higher gear moving into subsequent quarters as well. The company is also actively seeking opportunities to diversify their products portfolio in bid to sustain their margins or in bid to improve their margins as well. Under the selected dividend yield picks, we have three companies here like UGTech, Pentech, and Burmaz Auto. All of them has a dividend of more than 5%. For example, UGTech have prospective dividend yield of 6.74%, Pentech at 6.67%, B Auto at 8.94%. And also, based on the latest price as of 31st of December, whereby we have issued our report on the next working day after, and with a prospective target price, they still have a potential upside. Some of the key risks that we have is the further depreciation in the local currency. The weakening of the ringgit against the greenback, as well as other neighboring countries, may likely to deter foreign investments. But with the prospects of the improving ringgit, with the prospects of US interest rate cut, we expect the ringgit to at least see stability moving forward. Sooner than expected US presidential election. Should US call for the election sooner than expected, we expect volatility to kick in again due to the uncertainties. Inflationary risk. Although prices of commodities have cooled down, the rising crude oil prices may continue to deliver ripple effect to power pressure for central banks across the globe to tame inflation. Elevated interest rates. Corporate profits may likely to get discounted at higher rates. For example, if interest rate were to continue to ascend, we think that the companies which has large gearing will likely to be one of the underperformers. Wobbly economic outlook at our eastern counterpart. China is deemed to be one of the largest trade partners to Malaysia. Slowdown in economic activities in the aforementioned country may result in the weaker external trade demand. Moving on to the next part of the talk, we have the technical outlook. This is the chart of the FMKLCI. Overall, the FMKLCI is a tale of two halves, whereby the first half we are seeing the downbeat tone on the FMKLCI, hovering largely below the SMA 200 level, which is the red color line. And since then, we are seeing the FMKLCI has recovered and hovered mostly above the SMA 200 level since then. On to the comments wise, the FMKLCI has found stability at the start of the second half after a dismal performance in the first half, with the key index rebounding and rising above the SMA 200. In the recent bullish movement on the FMKLCI, the key index has also break through above this 1465 resistance level as well. So for now, technical indicators are fairly mixed, with the SMA 50 has formed a golden crossover above the SMA 200. Meanwhile, moving average convergence divergence MACD is floating sideways near the signal line, but it's hovering above the zero level, suggesting that still picking up. Likewise, the relative strength index RSI is lingering around 50, and should it steady above that, the aforementioned level will likely to see further strength or give further strength towards the key index. For now, moving forward, outlook turns promising as we advocate traders to monitor for a potential breakout. It has already breakout in recent days above the 1465 firmly. So the next resistance we are looking at is at the 1488, followed by the 1500. Downside wise, support is at 1435. So next, I'll pass on to Megan for the commodities market review and also the outlook.
Yep. Come back to me. We'll have to do some chart adjustment. Basically, I'll be presenting on the technical side. So fundamental, you may go to Kenneth. He's the expert. Me, I'm just a chartist. Okay, well, I actually represent a derivative. So FBMKLCI, you can't actually trade there. So what you can do, you can actually trade in derivative under FKLI. So this will be the market. So the overview, today I'll just go for the overview of the market because if let's say you are interested to trade on an intraday or a short-term trading, you can actually contact our derivative team. We can help you in the trading. But because, probably I'll just see you this round, the next round will be the second half. So I'll probably just go for an overview of the market outlook. What are the technicals what are the points that I'm actually looking at? So for FKLI, FKLI index is actually attempting to touch the resistance point at 1,005 level. So same as what Kenneth has been saying, 1,005 is one of his level. So not far from the Friday close. This week, for the start of the week, the FKLI has been churning up. So it actually break out from the consolidation since early of the week, from 50 plus to 90 plus. So it's now 90, close at 90 on Friday. But however, there's 1,005 is not too far from now. So, but what market is actually still not firm from an upside. If you say about bull market, I wouldn't say a bull market yet because it's not confirmed. So we still have to wait whether they can support well above 1,005. Next 2 weeks will be the crucial time to gauge the movement. So I think this is a time that you should watch closely on FKLI. So if let's say there will be a two-way that we're actually expecting if let's say market were to go on a bull or a bear. So if let's say market can go right above 1,005, which is here, this is 1,005 line. If let's say market can stay firm above 1,005, probably around here, this is the movement. The line in green is the movement they were expecting. So if let's say market go this way, there will be a retracement here, and if this supported, there is a very high chance that market can go for an upside. So I think from a soft landing probably to a no landing eventually. I don't know whether it will happen. Let's see. So therefore, these 2 weeks will be a very crucial week. Well, what if when market touched 1,005 and it doesn't break through, doesn't penetrate, and it resisted around there? Because this is a very strong resilient point. So if let's say it doesn't do that, there's a chance of market consolidate around this point before a downside if let's say it couldn't able to support about 1,005. So this will happen. So we shall see what will happen if let's say anything above 1,005. If next week we can see something around 1,520 and come back supported above 1,005, we could expect market to have a very nice rally after that. So probably if let's say that happens, we are actually looking at 1,009. Well, of course, I'm talking about the first half, not talking about intraday trade, yeah. So this will be for first half. So the other market, this market is a very volatile market in futures market. So if this is very suitable for intraday or short-term trade. So myself as a trader, I'm actually a swing trader. So I'm more to a short-term trade. So for CPO, we are actually looking at market is actually going through, as you can see here, market is actually going for a triangle. It's a contraction. Therefore, we do not expect any fantastic volatility at this stage unless the market swing out of this contraction. So swing out of this contraction meaning it has to come here. It has to break this box in order for it to go out of this swing. So meaning it's here. So at the moment, market is quite still. So what you can do now is more on a short-term trade. Even intraday trade is not that easy lately. So I would say short-term trade. Crucial point will be looking at 3674 and the resistance looking at 3820. So 3674 is actually the temporary support that we're actually looking at. If you are talking about FCPO, there is a chance of market is slightly leaning towards an upside. So there is some support which is 3674. If let's say market can stabilize above 74, there is a chance of market going to 3820. So this is my view. So what if market don't do that? So if market goes supported above 74, this is what we are expecting, going back to around this line 4425. 4,000. This will be the first level. Second level will be 4425. But what if market couldn't make it? Market went to probably this level 3820, but they went down south. So that will actually spoil the contraction and probably market will go for a downside this year. But we don't know yet. Let's see whether this level can be supported. If you ask me, my trading plan is if let's say this could be supported, there is a chance of market going for an upside. As you know, CPO has been going for an upside since 2020 to 2022. Market has been going from 1,009 to 8,000. It was a very strong market. It's like a 10 years one time kind of market. It happens last 2 years. So after that market corrected. So it is normal that market go for a consolidation after a wild run. So this is very normal. Well, contraction is a good thing. Yes, you would say that it is very boring to trade. Yes, it is. But however, whatever wild thing that want to happen beforehand, right? Whatever wave, big wave that's going to do tsunami, tsunami also don't come like, in the split of second, they will show you some symptom that, my water is not that still anymore, it's jittering, This is the stage where market is doing a contraction. Later on, they will show where they want to go. So don't be bored by the current market now where it is not moving. This is the time where you should look at the market, whether it will be turning out as an upside or turning out as a downside. Okay, the next one is a favorite for everyone. It's a gold market. Gold market has a very wild run also. Well, gold market has been quite still actually, if it's not because of the MCO, if it's not because of all the big matters, economy, recession, before that we were expecting recession, but it did not happen yet. So therefore, market consolidated. Well, this is the best time for gold to trade is because normally gold don't run wild. Normally gold is quite a stable instrument, but however, because of the uncertainty, that's why it's a good time for gold trading. So at the moment, I would say there is a good opportunity to trade. The opportunity, where is it? Okay, gold market recorded new high in early December and quickly corrected. This is a December. Market went up and quickly corrected more than 150 points within a week. So this is a very drastic down after they have went to the record high. This is a historical high, which happened in December. So trading opportunity is actually here. I don't know whether you would want to have a bet on this. Well, any failure, there is a selling opportunity at the moment. But don't quote me. There is always an upside and a downside of a market. Okay. So the trading opportunity is that if let's say any failure to stabilize above 2061, which is here, this is a 2061. This box, the top, consolidation top. If let's say market couldn't support above the prices, couldn't support above 2061, market have a chance of coming back down to here. That is quite a lot. If let's say market come back from 2061 to 18, meaning market is coming down about how 150 points. So there's a lot of ang pao to grab. So it's everywhere. Ang pao is everywhere. See whether you are there to grab the opportunity. So I would say this is the best trade if let's say you could grab the opportunity. But what if market do the other way around? There's an upside, but however the upside is limited. So if let's say market could support above 2061, which is here, let's say this happens. If let's say market, the green line will be the line that we're looking at. So if this one is supported, 2061, there's opportunity of market going up to the previous high 2148 or even higher. But however, like I say, if you measure with ruler, this potential gain and this potential gain, definitely this will have more ang pao compared to this one. Of course, I don't discount if let's say market could support to above 2061, there's a chance of grabbing about 100 point ang pao. So this will be for gold. Okay, so we will go to the regional market. Let's talk about US market. I will be only touching about derivative team. We actually launched on global trading. So we'll be offering all the micro series product. So you can inquire our staff or there's a chat. I think we have some contact there. So there's an advertisement banner. So you can click on that or contact our staff for more information. So roughly I will look at 3 major markets in US. So let's start with Dow Jones. This Dow Jones. Dow Jones went to the historical high. They recorded the record high yesterday night after a strike of positive gain since November 2023. At the current market prices, there shall be no, I won't give any buy call at the moment until the correction kicks in. The sentiment at the moment is still on the upside momentum, but the potential gain is lesser. So therefore, not to say that, if market is going up and I short, no. I won't short at this moment, but however, since the potential gain is so limited, I won't ask for a buy call at the moment. So I would rather aim for a correction, which is a sell call. At the moment, I don't see anything that is happening now, but however, investors shall wait patiently for the weakness to kick in. We will only sell when market shows some weakness. We would not sell if market is so strong. Why do I have to suicide if let's say market is so strong? We go with the flow. We follow what the big crowds want to do. Okay, since if it's an upside, we do an upside. My selling is more for a correction. It's not for a super downtrend or so. My downside is more for a correction. So what are we actually expecting? The crucial point is actually at 37083 at the moment. Market close yesterday was around 477, 37477. So if market shows their weakness to 37080 around there, I don't judge me on one point because support or resistance is a region, it's not a point. So I'm just giving you a point because it's easy for everybody to see. Okay, so this, if let's say market could come back down to around this area, market has a chance to do correction. So if let's say market go down and come back to 37083, I would go for a sell call. So of course, every trading you need to have risk management. Stop loss must always be there. Stop loss is actually the most powerful thing in trading. If you are wrong, admit it, cut lost. This is what we should do. So what are you actually expecting if let's say there's a downtrend? Not to say downtrend, correction. If let's say there's a correction, I'm actually looking at 34407. This will be the target price. So it's about about 3,000 point, 2,000 or 3,000 point. So that would not take overnight, yeah, please. That will probably takes you about a month, 2 months, once this kicks in. Okay, so at the moment, nothing that we can do. Wait for the weakness to come. So second market that we're looking at, Nasdaq. This is a favorite of all time. Nasdaq also recorded historical high. In this case, is at their consolidation top. So this box, I box it up for easy viewing. This is a consolidation box. So what is a consolidation box? Meaning market will go up, sell here if let's say market is weak, long here if market is strong. So that is the consolidation box. Okay. So at the moment it's at the consolidation top. So it will be a higher chance for market to retrace unless it could support above here. It could support above this box. Something like this. If let's say this, they wiggle, and suddenly, you know, I don't want to come down. I want to go up. Okay, probably it form a double top. Came down. I just want to stay here. So probably they will just do that and continue to go up. This will be an upside, but like I say, it's a limited upside at the moment from what I see because it's a historical high. You wouldn't know which is the next level because there's no data to refer to. Of course, you can do with your Fibonacci to get your number, but however, for R&R, for your risk and reward ratio, it doesn't it doesn't work for me. So therefore, I wouldn't ask for a buy call. If let's say you want to do intraday, you could try this for an upside. But however, what I am aiming for was this. If they can come down, I would see it around here. I put it in other color. The one in red. This is what I'm aiming for. I don't know whether it will happen, but if let's say market came down, rebound again, and resisted around this consolidation top, there is a chance of market coming back down. There's a lot of room for market to come back down. For a retracement, don't quote me that this is a downtrend. No, for a retracement. Because this is an upside, I don't want to discount that. The upside momentum is still there. We only trade for a correction. So if let's say market really come for a downtrend, it has to continue. What will happen if it's a downtrend? Probably it will be like that, like that, like that, like that, and like that. This is more possible for a sell trend. If let's say this doesn't happen, I won't see any bear coming in. So at the moment, we will only short if let's say market is going for a short for a correction. That's it. So the crucial point is 16660 and the support is 15691. So what is the market doing now? Yesterday closing, market is doing 16307. So meaning if let's say there's another rebound here, which is 16660, I will tend to short here, of course with my stop loss, please. Then I will be expecting around this 15691. Second level will be here, which is 13. So there will be a few thousand points. So downside is more yummy compared to an upside. So the last one, S&P 500. S&P 500, as you can see, it is also a consolidation box. So the difference is there's a historical high previously, which happened in January last year. So at the moment, I think it might come. I don't know whether it will come or not. But however, it's not historical high for S&P 500. But however, it's still near high, new record high. So at the moment, same thing, consolidation top. We will just go for a short call. Also, correction, short for a correction only. So any failure to support above consolidation top would trigger a retrace. So same thing goes. If, let's say, market come down here, and then they want to break through, supported, chance to go up. So this is in green. This will be an upside, a potential upside. What if market want to come down? They will do this, probably here, do a rebound, and continue to come down. We change the color to red for a down. So this will be well, I was just giving you a illustration of how market could happen if, let's say, market want to come down. So this would be the pattern of how they want to come down. Of course, they can come down in any pattern. It can be consolidation for a month before coming down, or so it could be any kind of pattern. But however, overall, like I say, I only see you every half a year. So this would be my prediction if, let's say, market want to come down. If market want to go up, this would be my prediction of market, how they want to go up. So, well, going back to you, Kenneth.
All right. Moving on to the next part of the talk. So we have our technical stock picks. We have three technical stock picks. One is KPS. KPS basically has earlier rallied strongly before retracing, but it's largely supported around the SMA 200. I know that this chart is not updated, but we have published when this chart, when it's demonstrating this chart. Currently, it's actually surpassed both our resistance above the 79.5 and also the 83 cents. But fret not, there's still another resistance which at the upper tail early on at around the 91 to 92 cents. If price were to retrace from now, you can try to accumulate around these levels and to target back the previous levels. Support is located at 69.5 cents. Another company will be SDS. SDS still has not broken out yet, although it's been 1 week of trading already. Price is still very much on the recovery move right now, and is currently hovering above the SMA 200. It's also establishing the longer term uptrend formation with the higher high, higher low formation being formed. What traders can do is accumulate around the 70 towards the 72 cents, and we can monitor for potential flag formation breakout above the 73 cents level. The resistance are located towards the 77.5 towards the 80 cents. Support is there's a typo error that should be around the 69 cents level on the support level. Our last company it will be MN Holdings. It has also surpassed both our resistance level following the strong movement on the local stocks over the past week. But for now, our price is on the uptrend formation and has turned sideways recently. Traders can accumulate around the 50 towards the 53 cents. We can monitor for the potential short-term triangle breakout. Once there's a breakout above the 54 cents, next targets are 58 towards the 62. I think price is around the 60 cents right now. If price were to consolidate back, there will be a buying opportunity for us to accumulate. Support is at around the 48 cents level. So we are going on to almost the last part of our webinars today, the seasonality analysis. Looking at this table, this is the S&P 500 monthly table performance. If you recall that during the earlier part of the talk, we think that the US presidential election will likely to take place in the second half of this year. So what happens back in the last election, the 2018 US presidential election? So the US presidential election took place on the 6th of November 2018, and the month before that, we are seeing a lot of volatility taking shape. So I think once there's a date of the US presidential election, we can already start to take caution on our position. But this is just for the S&P 500 or the US stock markets. So if you look at the October month, there's a lot of volatility going on in the month of October. But before the month of October, it's been very calm. It's been green for the past couple of months. so the uncertainty over the U.S. presidential election has driven the profit taking or the pullback on the U.S. stock markets. So we have to be cautious on this. Once the dates of the U.S. Election has firmed out. But on the FMKLCI wise, pretty much there's not much trend on the first half of the year. But I just want to highlight the month of September. Traditionally, September has been a relatively weaker month. Over the past close to 20 years, about 12 months has been on a negative, and these 12 months, out of these 12 months or 12 years, you can see that about 6 to 7 consecutive Septembers has been a negative. So you have to take caution on the month of September moving forward. But on a brighter note, on the month of October is traditionally relatively positive. This is, I think, mainly driven by the budget announcement. Traditionally or historically, budget announcements takes place in the month of October. So you can probably take more position in October. And another month to take note of, it will be the month of December. Then over the past many years, I think even before this table, before 2005, traditionally or historically, December it has been a very good month for FMKLCI. This is mainly due to the year-end window dressing activities. Only 1 year during the month of December, the FMKLCI has chalked in negative performance. During the year of 2014, if you recall that what happened during that period is when the crude oil prices starts to tank from about $120 per barrel. It has tanked sharply. So that has led to the underperformance across oil and gas giants like Petronas and Dialog, Yinson, which are the FMKLCI constituents. So that has resulted in a negative performance on the FMKLCI. But otherwise, traditionally, this is one of the best months to trade. I know investors always say that during the year-end period, many of the investors, fund managers goes on holiday. But actually, this is one of the best months where you can take opportunity to long your FMKLCI. Not just FMKLCI, you can long onto FKI as well during the month of December, traditionally. And just one thing to highlight is also that over the past many years, even before 2005, we haven't seen 3 consecutive years of the FMKLCI negative, falling into negative territory. But except for during this period, 2013 towards the 2016, and also the recent 3 years. So if history were to repeat itself, we may anticipate for potential better year for the FMKLCI moving into 2024. Over at the FM small cap wise, it's a slightly different picture. There's not much of the trend ongoing, but seasonality or traditionally, the month of December is pretty good for the market. But I just want to caution, especially in the first half of the year, on the FM small cap wise, which measures the average performance of close to about 700 stocks listed on Bursa Malaysia. May is traditionally relatively volatile. You can see that throughout the past close to 20 years period, May is usually on a negative tone. There's an SJ call for will be the sell in May and go away. So if you because you want to avoid the volatile May month. So except there are some exceptions. For example, like 2009, this is because of the recovery from the subprime crisis. 2013, when the Pakatan Harapan has taken over, there's a sigh of relief. There was also the 2020 in the month of May because of the sharp recovery from the COVID-19 after a negative performance early on. So, but if there's no any significant occurrence, traditionally May is usually on a negative, traded on a negative tone. So that ends our presentation for the first half 2024 market outlook. So we'll move on to the Q&A if there's any.
Yes, there's a question coming from a viewer. He was asking about YTL Power. Is there any chance in a technical and fundamental view?
Okay, if you have followed me on Bursa MLT platform, Mirror Learn and Trade platform, one of my top pick was YTL Power, and it has actually performed really well, mirroring the similar move with YTL Power International. But for YTL Power International right now,
Really? When do you say that?
yeah, I've taken position in YTL Corporation since the month of end October or early November.
Oh, you should tell me I missed it. Oh, you see.
No worries.
You see the upside.
Market is still ongoing. There's plenty of opportunity moving forward.
I saw some targets 5 ringgit. Is that true?
Yeah, it could go up as much as that given their current developments. Fundamental wise, back to the question. Fundamental wise, I think they are still relatively fairly stable right now. I think there's still potential upside moving forward especially for YTL Power. But after the recent long bullish candle being formed on yesterday on Friday, we think that there could be a potential mild pullback taking shape if price can pull back and supported above the 2 ringgit and 60 cents level. I think that further upside may likely to present for the YTL Power International. But after a very long bullish candle, I think moving forward, a pullback will be deemed to be healthy for the gains to be digested before fresh legs will to kick in for further upside to take place. Fundamentally, it's still very much solid at this point of time. They're still riding on to their expansion in the Singapore market.
Okay. So, in a technical view, I would say if let's say there's any retrace, we could actually wait 2 ringgit and 39. What is your support just now you were talking
Around
about?
the 2 ringgit and 60 cents.
260 cents around here. Okay. So it depends on where is the high.
Yeah.
If let's say you guys at home, if let's say you guys want to go for a second round, which I also missed, probably I'll go for that, the second round. Well, we probably Kenneth is right that we will not chase if let's say market has gone wild, okay? We wait, you also come down, market come down, you come down too, all right? So if let's say market come back to a correction, then only you start buying. We see how, because you don't have to be a panic buyer. It's always panic seller, but no panic buyer, okay? So always remember that and don't rush in. So we are actually, for Kenneth is saying about 260. By chart, is actually looking at 239. If let's say, if there's any chance of market coming back down here, you could probably try. I don't know whether how it move, probably it's like that. If let's say it's upside, well, I'm just guessing. Well, probably when price come back down here or here, you may try to long again. Right? Any other question that comes in? Okay, there's another one. So, someone is asking whether the local market rally, do you think is sustainable?
I think that this is just a start of the rally for the FMKLCI following the breakthrough above the 1465 level. Our year-end target is at the 1560, so that I think that there's still room for growth on the FMKLCI. But after the strong performance in the past week, I think the FMKLCI may need to see a mild pullback first before further upside were to take place.
Okay. Another question. How can we make trading more vibrant should the market underperform?
I think, for example, if the FMKLCI or the Bursa Malaysia equities were to underperform, I think there's several instruments that we can look onto, like your ETF. There's like gold ETF. When markets underperform, then generally gold will be a favorable investment. Apart from like gold futures, you have your gold ETFs as well. At the same time, despite the Bursa Malaysia's underperformance in last year, the US stock markets has performed relatively very well, hitting all-time high near towards their all-time high levels. So there's also like S&P 500 ETFs as well. You can take you can manage your portfolio. You can diversify into like other markets apart from stocks across Bursa Malaysia.
Okay, okay. Well, just a personal question. What do you think about Inflex?
Inflex, maybe you can have a look at the chart first.
Okay, can.
It's actually a very penny stock, so not much comments on the fundamentals aspect.
Inflex. Because the last one we went to 33.35 and then it came back down to 1
Yes.
10 cent.
But for technical perspectives, it has already formed the short-term or the medium-term double bottom formation, and is currently staging a rebound towards near the 24 cents before retracing. So for now, we will continue to monitor to see how the retracement holds. If the retracement cannot hold above around the 15 cents level, then we may be seeing further correction back towards the previous low. But if we can find some signs of recovery from now, and the price managed to cross above the 20 cents and manage to stabilize above that, then we can continue to take position. We can take position potentially back towards the 24 or even towards the 30 and subsequently near towards the previous high at around the 35 cents on Inflex.
Okay, okay. So, is there any question? If you have any question, keep coming in. So, for derivative, I would like to introduce to you guys on this Hong Kong market. Well, Apex Globe, as you can see, we actually have done some rebranding and we have changed our logo. So it's not a scam, okay? It's really this logo. So we have changed this logo as well. Sorry. We also changed this logo in our platform. So we are aiming to change and to serve you better. So therefore, we also go on globalize. In derivative, we start from derivative in a globalization where we do some global trading. So, well, of course, when I ask you to go to do some trading, I would choose some market that is better for a trader to trade. I would say Hang Seng would be the one. First thing first, mini Hang Seng is cheap to trade and the volatility is there. And they trade the Bursa hours where they start from 9:15 and end at 4:30. You can actually ignore, they have night market too, you can ignore the night market because Hong Kong market, mini Hang Seng or Hang Seng is actually for intraday, it's more suitable for intraday. Since the volatility is there, you can actually start trading and it will not have any manipulation because this market is quite big. So the volume is there, so don't have to worry. So I will let you see how the chart actually works. So this is the chart. So overall, Hang Seng market is lying at at a sorry. Hang Seng market is actually lying at the support level, waiting for the next move. Now market is here, waiting for the next move. Hang Seng is a good market to trade because it's fit our Bursa trading hour and the potential gain and volatility is great. So this is a market that fits our intraday trader. So if you wish to know more, contact us under our chat room or live chat. You can actually see our contact and our advertisement. Contact our staff to open an account or to know more info. If you are interested to open an equity account with us as well, and probably to ask more questions to Kenneth, you can actually contact us as well. With our customer service, we will direct you all the questions that you have and we'll answer your question one by one. So Hang Seng, coming back to Hang Seng, if let's say you want to do some derivative global trading, I would reckon mini Hang Seng to start off with. So if you need some assistance on how to do this market, do contact us. We'll tell you what to do. So, if there's any question, is there any other question that is there any question that comes in? Okay, there's a question from Melissa. In every bull run, there is usually a team play. Do you think this round team play is property?
Yes, I think that the current team plays around the property as well. If you recall, what our sector picks will be the construction, property, healthcare, and technology. So these are some of the 4 key themes that we are looking at, together with, of course, renewable energy and tourism. So we think that property sector is expected to see further upside, mainly driven by the improving economic fundamentals, whereby the prospect of an interest rate cut may likely to drive, or the tail end of the interest rate up cycle may likely to drive the demand for properties. We think that the recent prudent launches from the property players, in order to avoid the oversupply, may likely to improve the market fundamentals as well.
Okay. So there's another question coming from Juan Gorino. Your view on Cloud PT?
CloudPoint, we do not cover this stock, but I know that it falls under the technology sector. Overall, I think that we still hold favorable view on the technology sector at this point of time. So I think that there's still potential upside. If prices of the technology-related stocks were to come down, I think traders may able to adopt the buying into deep strategy. So that may, in anticipation for a potential rebound, particularly towards the second half of the 2024.
Okay. Let me see, is there any other that's coming in? Okay. If there's no more question, we'd like to do some introduction and probably some commercial advertisement on our new product.
Buy old Telegram, hello, new.
The slide on new product. See it? Oh, I see. Well, Apex is taking a new milestone to offer new products to serve you better. We are bringing derivative foreign trading to another level. New platform with no market data fee. Well, if let's say you go to other firm, normally they will charge you a market data fee, which is a cost to a trader. So at the moment, we have no market data fee. We can only offer to limited clients who sign up today. So, and also our micro series, we're actually offering USD3 per way if let's say you join today. So if let's say you have an interest of trading micro product or other global product, let us know. Contact my staff in the advertisement banner. They'll register you or help you with more info. And fresh from the oven, discretionary trading in both equity and derivative products are now available in Apex. Let our professional trader trade for you. So we'll be offering this probably today is actually not official one, it's a soft launch. We would like to, because before that we were waiting for Bursa approval before that, but well, Bursa actually came back to us like this week, so therefore we can actually officially launch this product. So this discretionary trading would be for let's say newbie in investment, or let's say you have a lot of losses since day one of trading and don't know what to do and you are lost. You can come to us. We have a professional team to help you to do trading, and we have professional Kenneth to analyze the market for you. You just sit down, relax, and I wouldn't say it's a guarantee. It is not a guaranteed return in investment, but however, with the strategy that we have and with, of course, trading, we need cut loss. With the cut loss, with the strategy, and also the potential gain, the R&R ratio that we have in place, I think we can help you to make a better life, I think. Well, probably a better investment portfolio. That's what we aim for. Apex, we actually aim to serve you better, serve our client better. And if let's say you have any feedback or any things that you think you need us to improve on, do let us know. We'll try to figure out what to do and to serve you better. So last but not least, Apex Academy. So Apex Academy is actually aimed to walk you through your investment journey. This is an educational platform exclusively made for Apex investor and clients. You will get a lot of trading and investment information to drive your trading experience. So this Apex Academy is actually contains a lot of research information, and also we also changed and implemented some of our talk video. We actually video to let you know what you can do for the morning session and what you can do for afternoon session, so that sometimes if morning session you miss, probably afternoon session you can go for the trade again. So this will be in our Apex TV. This will be in the Apex Academy. All this Apex TV, research paper, trading recommendation, you will be able to see in Apex Academy. So we will later on, if let's say, but of course everything has to start with an account opening. So if let's say you have an Apex account, then we will send you a registration link to register. We'll prioritize for our client first. So whoever that is our assisting client, we will pre-register them first. Then after that, probably a year time or so, we do not know, until our management deem fit, we will actually open to outsider. But of course, the prerequisite is to open an account with Apex. So the other thing is our Apex Telegram is doing a migration. So say goodbye to the old Telegram and hello to a new Telegram. So we would like to urge everyone to sign up for our Telegram, our new Telegram. To join our new Telegram, you will be able to see equity and derivative information and also trading recommendation in our new Telegram. Our old Telegram will cease probably in a month time. We will not be updating after that. So keep in mind, please join our Telegram. We have a QR code, and we have at the side of the chat, you can actually click, there's a link for you to join our new Telegram. So join our new Telegram for more info and for us to serve you better. So I don't see any more question from the floor. If let's say there's none, then probably we'll call it a day. Kenneth?
Yeah, sure.
So, okay. Well, thank you everyone for attending, and thank you for your time. If let's say you have any feedback, there's an evaluation form later for you to fill out. Do come back with any feedback that you think fit or could help us to grow and serve you better. Let us know, feedback to us, then we will see how can we do. Well, thank you everything. Thank you everyone.
Thank you, and see you in our next event. Thank you.